Hi, this is George. In this video, we are going to see about monthly Nifty Martingale strategy. This is actually a continuation to the previous video that I have posted. So please do watch that video before coming to this video for more clarity. I have posted the link in the description. Please do watch that. Before getting into the video, please do subscribe to this channel and also join our Telegram channel for instant updates. Also, please do like the video if you genuinely like it. Let's get into the strategy. So this is actually an interesting betting strategy in option selling. So usually the betting strategies will be like an interesting thing. So this is like purely a betting or gambling strategy, this martingale strategy. So if you're interested in gambling or betting, then this is the place for you. Actually, in this, the capital record is actually unknown. I have explained more about that in the previous video, and also in the future slides you'll get to know about this. So what we are actually doing is we are, as usual, like selling our ATM call and put options for the monthly thing, and we are also buying a hedge of strike price difference of around 1,500 to 2,500 points. Actually, it should be in the multiples of 500 for liquidity, because the far away options will not be so liquid. So always have in multiples of 500 for buying side. That is like actually what I'm saying is if you're selling, say, suppose 17,200 call and put, then we should buy somewhere around 15,000 put and 19,000 call, which is not exactly like 2,000 points from 17,200, but these are like in multiples of 500. Also, please note that the buy premium, like it does not exit 50 rupees per side, maybe like 15,000 if it is like trading at 70 rupees, then go a little more further, maybe to 14,500, and buy somewhere around 50 rupees. I'll tell you the reason why I am saying in the next slide. In this video, I have explained the manual backtesting results for the last 6 months in the Nifty straddles. Disclaimer, this is only for educational purposes. Please do your research before taking any trade. This is not a recommendation, but just my view. Let's get into the core of the strategy. So entry, when we are entering is, we are entering like 6 or 7 weeks before the monthly expiry, and we are entering at Friday at 9:30 a.m. I mean, I'm saying 6 or 7 weeks before monthly expiry, and I'll just explain what I'm trying to say here. Say suppose if you are trying to do for the month of April, so April month expiry will be on 28th. So we can enter like 6 weeks before or 7 weeks before. There is this week, this month there is only 4 expiries, and in the previous month you can see there are 5 expiries. So we are going to enter like 18th of February, March, Friday. So here we are entering 7 weeks before. Say suppose if this month is also having only 4 weeks, then we'll be entering on 6 weeks before. Say suppose for February month, the February month expiry is on 24th. So for that we are going to enter it. Let me see some other month where there is only 4. Okay, yeah, November. So for November month, say if you are going to do for November month, the November month expiry is on 25th. For this we are going to enter at October 15th, which is like 6 weeks. 1, 2, 3, 4, 5, 6. So 6 weeks before expiry, 15th of Friday we are going to enter. And for the month of April, it is like 1, 2, 3, 4, 5, 6, 7, because 5 weeks of expiries are there in the month of March. So here we'll be entering on 18th, and for that we'll be entering on 6 weeks from expiry. So that is why I have given 6 or 7 weeks before the monthly expiry. Usually we take like somewhere around 45 days or 50 days, because we are majorly focusing on time decay here, and that is the only reason we are entering a bit early. And you're exiting like 2 weeks before the monthly expiry, or at least 1 week before monthly expiry. The reason is the last 1 week or last 2 weeks, if suppose there is a very big trending moves happening, then it will be very difficult to do martingale and do adjustments. So it is always ideal to exit 2 weeks before. But if before 2 weeks, if you are in a loss, or if you feel like market is going to reverse and you might get more profit, then you can maybe wait for 1 more week. But definitely don't take the position for the very last week of the monthly expiry. So the strategy and logic behind the setup is, so before that I'll just give an example on what exactly is a martingale. If suppose if you are new to this, and if you want to know martingale in a like in a minute. So I'll just take an example of a weekly expiry in Nifty. Like this I have given in the last video as well. I'm just repeating it in a minute. So Nifty 17th to 24th, let's just see. So I have put an option like 17th and 24th. And the 17th at 3 p.m. we are entering. That is after expiry almost of that week. That week we are going to sell at the money call and put. So 17,300. So 17,300 we are going to sell in call and put. Now we are going to see what it happens the next day. So next day you can see like the put side has gone more, which is market has gone down. So whenever we are losing, we will close the losing side and we will bet twice. That is, we will be like same 267 premium we need. Say that's suppose 270 almost it is. So we need to sell 2 lots of put options, which will give you 270, which is like 270 by 2, 135. So we are selling 135 2 lots. We will see where 135 is. We are getting almost 125. That is fine. 125 into 2 we will sell. So now adding like multiplying 2 into 125 is like almost 250, which is somewhere near 270. So we are fine with that. So now we keep seeing like what it is happening. So next day also it is the market is reversed. So we are in profit only. And by the end of 24th, we can see like we are getting the maximum profit. But this doesn't happen always. And that is what I have explained in the previous video. That is the reason we are making this video to say when we can enter and when we can exit and what are the possible adjustments that we can make to make it more profitable. So this is the simple martingale strategy. Now we are not going to do this way, but we are going to do in monthly options, because monthly, as I told like last week, if suppose some boil move happens, it will be a problem. So we are going to do like 45 days before, so that we will not end up in a very big loss. And now coming to this, so we always buy OTM options for hedging, and actually this is not majorly for hedging or protection. The primary objective is for margin benefit, because as I told before, like the capital needed in this strategy is kind of unknown, because we keep multiplying it by 2 or whatever the number you want to make it into out of the money options. The one that is sold in ATM, that should not go into deep ITM. So we keep pushing it to OTM by selling twice or thrice the quantity. We'll just make it more. So for that we need more capital. So for that alone we are going to buy more of OTM options. So ideally it can be like as wherever you are getting cheaper you can do, because our aim is not to make money from the bought option, but we are just using this for like a capital benefit, margin benefit purpose alone. Now as I told before, never do weekly options, because it will be like if there is a violent move, then you'll be in trouble. Now once you have entered, after selling the ATM call and put, if VIX, that is the volatility index, spikes too high, if it spikes too high, and or if the premium gets increased on both sides. So whenever there is any big news, or if there is any VIX spiking up, then you can see like there will not be any decay in the premium, but instead both the sides the premium will increase. So at that position, say suppose you have not done so many martingale adjustments, and if you're having like only 1 lots or 2 lots, and if you're in a minimal loss, I will suggest that we'll just exit the position when maybe we can wait for some time and trade for the next month. Because if it shoots up, then we might end up in a problem, because already the sold premium we have is less and the current market premium will be way too high. So it is advised to close the position and maybe book a loss in that way. And one more thing is like it is good if you need to make adjustment sooner than later. What I'm trying to say is like, so once you have done the adjustment, the very next day or very in the next week, if you are finding it that like we are getting a market has moved or trended to one direction, if you're making the adjustment, now if you're going to double it, then at that point of time actually what will happen is like you'll get a very good premium and you will sell and you will still sit at the OTM options. You will not be in ITM or ATM. So in that scenario you will be in a upper edge. So that is what I was trying to say here. Maybe when I give you some more examples, you will get more clarity on these points. So let me show you some examples. First, let me show you the April example, which we didn't make many adjustments, which is the very recent month as well. So as I told you, for the month of April, so payoff date should be April expiry. Here also it is April expiry. For April expiry, as I told, like there is 4 weeks here and 5 weeks here, so we will be entering on 18th at 9:30. Let's see where is the market. 17,300. So let's sell 17,300 call and put, and it is 17,500, let's say, because we are going to buy in multiples of 500. So maybe 15,500 will buy. 15,500 is way too high than 50, so we'll buy 15,000. It is 54, that is fine. And other side 19,500, 19,000 only we are getting at 38. So that's what I said, like it need not be like exactly 2,500 or 2,000 or 1,500. We are just buying this not for protection but just for margin benefit. So we can buy where we are getting like less than 50 rupees for the first time. Going forward, maybe we can go little also like lesser, like 25 rupees or 10 rupees, because only purpose, as I told, like is for the margin benefit. Let's see where it goes in the next day. So now what we're going to do is like the first adjustment here is like we are going to like multiply it by 2 when our premium goes to 1.5 times. This I have not mentioned in the slide, I'm just mentioning it to you here. So this 530, or maybe we'll say this 500 for convenience, if this 500 goes to 750, because 500 into 1.5 is 750. Similarly 440 into 1.5 will be 660. So whenever we see that position, we are going to like do our adjustment, which we didn't see in the last video or in the last example. We just do whenever market is going in the opposite direction. We just do, when it is ITM, we are going to sell twice. But here we are having a rule that if it is our premium is getting into 1.5 times, then we are going to make the adjustment. Now our premium has not went to 1.5 times because our market has moved in the PE side. In PE side it should go to 660, but here it is only at 570, so we'll wait. It is reversed, so no problem. We'll see which leg is going to be tested. So far so good. Now you see like already 10 days has gone and it has not moved anywhere. In these cases what actually will happen is like maybe if suddenly a move comes, you will not get a very good premium. That's what I was saying the last point in the previous slide. So it will be always better if we get immediately, but we'll see what happens for this case. Okay, initially it was PE was trying to get tested. Now it has tested in CE side. So it will 500 into 1.5 is 750. It is more than 770 now. So we are booking at 770 here, and 770 by 2 is like almost, we'll say this is 800, so 400 or 380, 385, that range we have to sell twice the quantity in CE. So 380 we are getting, 380 into 2. Now we need to buy one. Let's buy somewhere around 22 rupees, one lot. So for every sell we need to have one buy. Now we already have one buy, one CE we already bought. Now we are selling 2 CE, so I'm buying one more CE. Now the position that we have is 17,850, which is actually in the money, and 17,300 put, which is out of the money. Now if market goes back below 17,850, we are safe, or else we might have to do more further adjustments. Market has actually increased, but here we as per our rules 380 is almost 400, and 1.5 of 400 is 600, but it is only 473, so we can wait. Market is actually reversing. So, and we have to ideally exit like 2 weeks before the expiry date, which is like 14th of April. Now we are at 8th of April, 11th of April. Market is between our two sold contracts, so we are safe here. So 14th was a holiday, so 13th we'll see. 13th we are getting almost 24,900. Actually, if you have waited one more day, it is going to be 26, but that's not, we are going to follow. We anyway got our profit, so 24,900. Okay, maybe I would have bought something else differently, so it is showing 24. So we are having profit, and number of martingale times we did is like one side we did 2 and other side we didn't touch only. So it is only one adjustment we did and we got a profit of this much. Let me show you one more example where we did 2 or 3 adjustments. Maybe for the month of March I will show. That is one more month previous to this month. So for month of March, expiry is on 31 and we are going to enter in the month of February. February also has only 4 weeks, so we are going to enter the 11th, and this is March expiry. So 920, let's see where the market is. Market is 17,400. 17,400, we are going to sell one lot each, and 15,500 will buy. Shall we? Okay, it is 52 rupees, so that's fine. 19,500 or 19,000 we can buy. 19,000 only we are getting a good rate. We can buy 19,000. Now let's see what's happening. So our adjustment will be either this touches 600 or this touches maybe 650 or somewhere around that. Maybe if you say 480, then 480 into 1.5 is 580, 680, 720. So 720 or 600, let's see. So this is already touched 600. So the next day only we are doing. So now if you see that, this is what I was saying in the last simulator as well. I'll just show you after, then I'll tell you. So we are going to book this at 659 or maybe 660, and we need to sell 2 lots of 330 in PE side. So PE side 330, 2 lots we are selling, and we need to buy one maybe around 26 rupees. Now when we sell 16,700, as I told, like if we are getting this opportunity in the very beginning, after doing adjustment also we'll be sitting in out of the money. You can see like it is 16,979 when we have sold 16,700. But last time when we did a martingale, we were actually in the money. So as market reversed, we were in profit. But still here we have a buffer of almost 270 points. Even then we'll be sitting in profit only. So that is advantage for us if market immediately moves. That's what I was trying to say there. So let's see where it again goes now. Now this 332, let's just say it is 320 or something. If it goes to 480, we need to make adjustments. Or else if this goes way too high, then we have to. For now it is fine. Actually market is going further down. Okay, so here it has tested. We said like 480, but it is already 534. So we have to book this 534, and we need to sell 4 lots of, maybe if we say this is 540, so 270 is what we need to sell. 270 into 4 lots. We can just divide this by 2, 540 by 2, which is 270, and 270 into, you need to multiply by this by 2. So 270 by 4 will be equal to 2 into 540. So 270 in PE side, we need to sell 4 lots. We need to buy something at more 2 lots, because now we have 4 put legs and 1 buy of 15,500 and 1 buy of 14,500, and now 2 buy of 13,000 P. So this should be always equal 4 for margin benefit. Now are we still, yes, 59.50, we are still sitting in out of the money options only. We'll just, now if this 270 goes to maybe 400, which is almost 1.5 times, then we have to make adjustment. I think yes, market is going further down. Almost 380 now. Way too high, so it has went to 520, which is very high. So we have to definitely close this. You can see like when it goes to 520 and all, like your MTM loss is showing 43,000. So you should not be very much panic about this, or if you're lighthearted, don't do the strategy or exit when you see this much of loss. That's all I can advise. So we are closing this at 530, and now almost 520, we'll say 520 by 2 is 260. 260 into 8 we need to see. So 260 to 59 we're getting into 8. and we need to buy something at 4 times. Now also we are still in the out of the money, only 15,200, and we have almost 600. So you can see like from 17,400 we are 1,600 points down. So further 600 points we have buffer. So hopefully we'll be in profit. Let's see. Now this 259, if it goes to maybe 375, we need to make adjustments. Thankfully it didn't go. And we have to exit it 2 weeks before, which is 17th. We are at 10th of March now. 11th, 14th, 15th, 16th, 17th. Okay, so we have ended in profit this month as well. Okay, due to some reasons this is showing 16. Maybe I would have bought a different premium that time. So it is 14,430. So like this I did manually for the last 6 months, and I can see like a few months it was like this time you can see like 8. So 1 was converted to 2 to 4 and 4 to 8. So 3 times we did martingale, and 3 other months we did only 2 times. And 1 month what happened is like first initially maybe put side was tested once, then it reversed, and in the other side it was testing 3 times. I don't know which first put was tested or call was tested, I'm not sure, but both the side it was tested once. So always beware that when you are like one side is tested, don't just go and do plenty of naked selling in the other side, because at times it can do a sharp V-shape move, and that is also difficult. So please have these things in mind. Now, as I was saying, like if you are a conservative trader, when you see a very big MTM loss, and if that is more than your risk appetite, then maybe you can stop after few rounds, or maybe don't even try this strategy if you are like risk averse. But if you want more reward, and if you feel like betting is your thing, or if you have so much capital and if you don't know what strategy to implement, then this can help you. And also you can like the other non-tested side, maybe you can sell naked selling for OTM. As I said, like you can even do V-shaped sharp move. So if you're selling naked sell, go so far out of the money, or you can do some credit spreads, or you can do some any ratio spread as a reference trade to increase your profit more than what you're getting here. Again, I want to reiterate that it is a very risky strategy, so please be very cautious. And in the last video also I have told like this is not a strategy that will make you rich, but this, if you are rich, you can make this, you can do this strategy, but actually it need not like be always that you need to be rich, because these like maybe 4 plus 1 or 8 plus 2, this is not going to like cost you, or like margin is not required, is not way too high, and still you are going to get somewhere around 80 to 20,000 profit, which is like for last 6 months I told like 1.12 lakhs, which is a very good profit. So yes, even a retailer can do, but please understand the strategy fully before implementing this. In the next week again we will see some other interesting strategy. Thank you.